Good afternoon, everyone. Thank you so much for joining us. My name is Janet Wright. I'm with the FSA Outreach Office in DC. And I have with me today Christine and Christiana, who are going to talk to you today about deducting residual fertility. Okay, and with that, I just want to take a few minutes to do housekeeping, one of which is that this presentation is being recorded and it will be posted to farmers.gov/taxes in approximately 2 weeks. During the course of this presentation, you're able to enter your questions into the Q&A box, and they will answer as many as possible during this time we have together today. And so with that, I'm going to turn it over to Christine and Christiana, and you guys take it away.
Awesome. Well, Janet, thanks for having us, and thanks everybody for being online today. As Janet said, I'm here with my colleague Christiana. I'm Christine Tidgren. I'm the director of the Center for Agricultural Law and Taxation at Iowa State University. And Christiana and I are both attorneys, and I'll let Christiana introduce herself.
Hi, everybody. It's nice to have you all online. Like Christine said, I'm Christiana Kutu. I work with Christine at Iowa State in the Center of Agricultural Law and Taxation. And we also have a beginning farmer center that I'm the director of.
So we are just really excited to be on this webinar with you today. We will provide the slides later, and when we do, we'll put our contact information out there. I'll also put a couple of links to maybe resources that might be helpful in addition to whatever it is that we talk about today. But I kind of wanted to start off why the webinar. It's kind of a topic that is a little bit obscure to some people, and yet to other people who may be listening, this is a question that has been coming up a lot. And that's what caused this webinar, is really in the last year or so, we've had more questions on this topic than probably any other topic in the agricultural tax world that I would say, because our specialty at the Center for Ag Law and Tax is really agricultural taxation. So that's why we see some of these questions that other tax professionals might not. And so the idea is, is there a deduction for me if I buy a piece of farmland where I can actually get a tax benefit for the value of the fertility that's in that land I purchase? And we're not gonna go into that answer with anything dramatic right away. What we're going to do is sort of unpack what law we have. And so we're having this webinar really to educate about the law that underlies this question, because I will say it's complicated. And I will also say that our intent of the webinar is not to be prescriptive. We are not here to tell you what it is you can do and what it is you can't do. That is not our intent. Again, this is a complicated question. People are going to have to make their own decisions, but we want those decisions to be grounded in what the tax code, the law, and any associated guidance says. So, Christiana, what would you like to add to that?
Yeah, I think you summed it up pretty good, Christine. Hopefully, as we walk through the slides that are going to follow, you'll see the reasoning for why certain deductions may be taken or may not be taken. And this will make a lot more sense as we go through it. But it's been an area that we've had so many questions on. And if anything, just continuing to have more and more questions on. So we want to take the time to sort it out in this webinar today.
So I kind of want to start with an example, and this is kind of a classic situation that I've seen multiple times, seen a lot of spreadsheets, seen a lot of people call with the question of, what can I do with this? So John buys a farm, he pays $10,000 an acre for the farm, and then somebody tells him that there's a lucrative deduction he can take for the nutrients that he purchases along with the soil. And so, he pays professionals to do a study, he gets a spreadsheet, and the spreadsheet values all of the nutrients in that land that he purchased at $5,000 an acre. That's pretty substantial, 50% of the price of the land itself. Now, the information that comes with this says that this is not tax advice, it's just valuing the nutrients in the soil, and that John has to consult with his tax professional, his CPA, to determine how he can use this information on a tax return. So this is kind of a common situation. And then the question arises, so what does the professional tax person do with this information? And this is where we usually get our calls. A lot of times it's not necessarily from the farmer. Many of you listening might be farmers. Some of you might be tax professionals. It's often the tax professional that will call us to say, I don't know what the options are here that stay within the bounds of the law. So I'd say, would you say, Christiana, this is a fairly common set of facts that we might see?
Yeah, no, it is. And I mean, yeah, usually the questions are from tax practitioners, but also even sometimes it'll just be the general question from farmers saying, I might be inheriting a piece of property or I might be purchasing a piece of property and I heard this might be an option. So what is it basically?
So I guess I'd say that leads to the question of what can John do? And there's kind of like two schools of thought, John, because he paid someone to do the study, he might feel like he can just take that $5,000 an acre deduction on his Schedule F, and he might just want to find a tax professional that's willing to do that. Or he can work with a tax professional who will look at the data that's provided and determine what deduction is supported by the law. And so I would say that even the companies that are doing these studies, nobody is advocating for answer A, because all of the information that's even on the spreadsheet says this is not advice to take a particular deduction. So it might be a little bit confusing if you have this spreadsheet that says, your nutrients are valued at this amount, to not just say, isn't that the tax deduction that I can take? And so our point here is to say, I think you really need to work with a tax professional who will look at the data, help you look at the law to figure out how your facts line up with what the law says. Do you have anything to add to that, Christiana?
No, and what you'll see on the slides as we progress is the reason why it's so important to work with a professional a tax professional who's looking at your specific situation and your specific facts of your case, your tax situation, is that you're responsible for reporting something in the most accurate way. And so we'll show you why that's important in the next few slides and why it's important to work with someone who you can talk with and who you trust.
So really, we kind of have the goals today of education. That's really what we do. And so the first area that we really want to dig into is just what law is relevant to this particular question. So we're going to start with, when can we take tax deductions generally? When is fertilizer deductible? What is Section 180 of the tax code? What is residual fertilizer? And what can I do? Can I take a deduction for that? We're going to look at any guidance that might exist as well as court cases. What about the seller? Like, somebody's selling this land to you. Does this impact them at all with what they do on their tax returns? And then we're going to close by sort of looking at some common situations and thinking through those together. So that's sort of the roadmap of where we're headed. And I guess I'd say the first place I want to start is just kind of the basics for anybody that's on here that's not a tax person. And our goal here is to make sure that we're communicating this in a way that is understandable to you, whether you're a scholar of the tax law or not. So the goal is to just make this as practical as possible. So hopefully we'll succeed in that. But a couple things that we want to start with is that, you file a tax return every year. You tell the IRS how much income that you had, and then the Congress over the years has written laws that have given us the ability to take deductions from that income if we're in a business to recognize that sometimes when we have to outlay an expense that cuts into our income, so we shouldn't have to be paying tax on our gross income, we should be able to only pay tax on those things that really end up to be our net business income. I mean, that's the very simplified, overly simplified version of what deductions are. And so because that's what a tax deduction is, the law says that deductions from income are really only available if Congress has given you that ability to deduct. So you have to be able to point to some specific tax provision that gives you the authority to take a tax deduction. And so, simple English, an expenditure is only deductible if a deduction is specifically allowed by the tax code. And this is wisdom that's come to us from our United States Supreme Court many decades ago. It hasn't changed for years. It's just where we are. The Supreme Court has said you have to be able to point to a specific statute and show that you come within those terms in order to take a tax deduction. So we have to find a clear provision. So our kind of goal here is to kind of go through the different provisions that might support our ability to take a tax deduction in the case of fertilizer, and then taking it the step further into the case of residual fertilizer supply. So again, kind of shifting gears to what that means if I file my tax return and then the IRS says, hey, wait a minute, Christine, what were you doing? How did you come up with this deduction? The burden is on me to show them where it was that I found someplace in the tax code that supported my idea to take the deduction. And so, we can look at rules, regulations, court opinions. So we're not necessarily going to find a specific line in the tax code that's going to apply to every single situation, but we need to find a tax provision that we can use to say, yes, our facts fall within that. Look at this court case, look at these regulations, and that's sort of where we go. Again, the United States Supreme Court has told us that the burden of clearly showing the right to a claim deduction is on the taxpayer. So we might not like that burden, but unfortunately it does fall on us. And then Christiana, I sort of wanted to point out the penalties. Do you want to talk, right here? It's a risk. Anytime we take a position on a tax return that the IRS disagrees with us, we don't necessarily end up with a penalty if we can show that there was substantial authority for the position that we took. So it's a little complicated, but what it means is we might be wrong with the position that we take, and the IRS will make us pay back the money that we took an excessive deduction, but we might not have a penalty, which is usually 20% addition to tax, which we really don't want, if we can show that there was substantial authority for that position that we took. So how do we get substantial authority? We'll look at that in a minute. But if we do not have substantial authority, and we have a substantial understatement, which is just 10% of the tax or $5,000, whichever is higher, then, or we have negligent disregard, then we'll have to pay a penalty unless we can support it by looking at the law, showing the IRS where our authority came from, and showing that the weight of the authorities for my position is really substantial as compared to the weight of the authorities supporting the opposite position. Now, you might think when I read substantial, I think, whoa, I really have to tilt the scales. If you look at some court opinions, there's actually been a number that's kind of been thrown out there, 40% chance of success. So you don't have to have the most potent tax court case out there to avoid the penalty. You just have to show that about a 40% chance that the IRS would have agreed with my position based on my argument in the law is going to be substantial. So kind of that gives us a little bit of information. And what is the authority that we can look to? Well, we can't say that an IRS publication is substantial authority. We have to look to specific areas of guidance that are spelled out in the statute. And those include statutes, regulations, revenue rulings, relevant court cases, sometimes private letter rulings, sometimes taxpayer advice memos. It's all spelled out in the statute, but it has to be specific authority that's been provided. Now, I talk about substantial authority as being the best way to avoid a penalty. So let's say I take a position, IRS disagrees with me, but we all agree, well, but I had a pretty good argument. You disagree, so I still have to pay back the tax, but you're not going to slap the 20% penalty on because here, look at this particular regulation. I can see how you could have argued for yourself in that method. There is one other way, though, to avoid the penalty. And that is where you might not have substantial authority. You don't have a 40% chance of prevailing. Maybe you really just have a 20% chance. That is a reasonable basis. So there was a reasonable basis you had for taking your position. If you have a reasonable basis but not substantial authority, what the tax law says is, okay, you can avoid the penalty, but the only way you can avoid the penalty is by disclosing your position to the IRS in advance. So what does that mean? It means I take a position on a tax return, I take a deduction that I think the IRS might disagree with. I look at all the relevant authorities and I say, I don't think I have enough support to be substantial authority. But I think there's a reasonable basis that somebody could go along with this. If that's where I'm at, then I have to file a disclosure at the time I file the tax return. And it's a special form, it's an 8275. I have a picture of it there. But again, this is something I have to do when I file the tax return. I can't wait until I get an audit and the IRS says, I don't agree with your position. And you're like, well, here's my disclosure, and avoid the penalties. So if the IRS determines, or a court later determines, well, you had a reasonable basis, but there was no disclosure, you're still going to get that 20% penalty slapped on if the IRS disagrees with your position. So, Christiana, do you have anything to add to any of that sort of background information before we get into the details of this topic?
Yeah, what I'd like to add, and I think it was just evident as Christine, as you went through all the different elements of the substantial authority, and if you might need to disclose ahead of time if you choose to do that. I think what it points out is that this is not just a clear answer. This is probably a situation where you need to discuss it with your tax preparer and evaluate it and understand the potential risks that go along with it. Ultimately, it might be a risk analysis of what happens if you take the deduction. And so just keeping that in the background as we start going through the specific elements that we'd look at.
Okay, so now we're going to actually turn to the topic at hand, which is residual fertility. But before we can really dig into residual fertility, which is basically fertility that's in the ground already, we have to look at how the tax code supports farmers in deducting the cost of fertilizer in the first place. So those of you that are familiar with your Schedule F, you know that on line 17 of Part 2, which is farm expenses, is where we categorize our fertilizer, our lime. So if I'm a farmer and I fertilize, I get to take a present deduction on my Schedule F. And we'll talk about why, what code provision we use to do that. But I just slap it on that return, and that is a valid expense deduction. But fertilizer is kind of more complicated than, say, buying a tractor. So kind of wanted to kind of back up, because to really understand this topic, I think you really kind of have to understand the underlying law. And so generally, if you put seed in the ground, you feed to your livestock, that's going to be a business expense. But business expenses are generally deducted under a code provision called 162 only if you use it up in 1 year. Tax law really generally says, if the benefit of whatever you purchased for your business exceeds 1 year, then you kind of gotta do something else, right? So this makes sense if you think about buying a tractor. We have accelerated expensing under Section 179, we have bonus depreciation, but the foundational way that we recover costs for buying a tractor would be to depreciate it by taking a deduction every year for 7 years if it's used, etc. So we're kind of used to that already. And so fertilizer was sort of its own special the provision in the tax code because it presented a little bit of a puzzle. And of course, this goes way back in time because farmers would put fertilizer on their field, and for the most part, farmers would deduct it just right away as they put it on as a business expense. And way back in 1947, the IRS looked at that and said, well, wait a minute, this doesn't really match up with the way the tax law works because you're spreading lime on your farmland. And that value of that lime that you're putting there, it's not used up in 1 year. It's an exhaustible capital expenditure, but really, anytime you have something that is exhaustible over time, you can't take the deduction all at once, absent a special code provision that allows you to do that. Instead, you have to do what we call amortize it over its period of effectiveness. And so that's what the IRS said back in 1947. Farmers, when you put on your fertilizer, you can't just take the deduction in 1 year. You have to figure out for how many years is the life of that fertilizer useful, and that is the number of years over which you have to take that deduction. And this guidance really, it said, it's kind of like if you prepay your multi-year insurance premium, it's handled under the tax law just like that. You don't get to take the deduction of the cost of that insurance premium over 5 years at once because it goes over 5 years. Instead, you get to just take a deduction every year up to that 5th year. That's sort of the basics of how tax law works. Now, farmers were not happy about this because they were used to taking the deduction all at once. It kind of made sense for the cash flow of their business. So they did what any good citizen does, and they talked to their legislators. And in 1960, Congress said, okay, we are going to give farmers a special provision to be able to deduct the cost of their fertilizer in the year they apply it. And so that was the genesis of Section 180. And so that's been around since 1960 and it continues. So the law for farmers applying fertilizer, and I'm going to pull up the exact language of Section 180 because this is kind of in some ways the core to a lot of what we talk about. It allows you to take a present deduction for the purchase or acquisition or the application of fertilizer, lime, ground limestone, marl, or other materials to enrich, neutralize, or condition land used in farming. Now, we really have to kind of unpack the provisions within Section 180 because there are two really important factors to be able to use this. And the first one is the only people who can use Section 180 to take a present deduction. Now, if you don't use Section 180 and you're still using the fertilizer in the business, then you have the option too, even if you're a farmer, of still amortizing if you choose. But we're talking about for a present deduction to write the whole thing off, you have to be first engaged in the business of farming. And I'll tell you what the definition for that is in a minute. Number two, the land to which you're applying the fertilizer has to be used in farming. And so that means it has to be used for the production of crops or for the sustenance of livestock. And if you buy land that has never been farmed and then you apply fertilizer to kick off your farming, the law says, nope, it doesn't work because it cannot be used to pay for the cost of the fertilizer used to first prepare the land for farming. So Section 180 has those two parameters. So the big thing is, am I engaged in the business of farming? And we're given very specific guidance through the regulations on what that means. And it means cultivating, operating, or managing a farm for gain or profit, either as an owner or a tenant. So if I'm a farmer that rents ground and I apply fertilizer, I can use Section 180. If I'm a landlord that is renting the ground out, the code, the regulations are very specific that if you are a crop share landlord, even if you do not materially participate, you can use Section 180. That is clear. If you're a cash rent landlord and you just receive cash for renting your farm out to someone else, most of the time you're not going to be able to use Section 180 because the regulations say the only way you can, if you're a cash rent landlord, is if you materially participate in the farm business. And it's a very rare thing that a cash rent landlord materially participates in the farm business because generally that's the whole point of a cash rent lease is you want the farmer to be farming. So those are the parameters that you have to fall into in order to use Section 180 just for the application of fertilizer. Is there anything you'd like to add to that, Christiana?
Well, you covered it, Christine. The only thing I'll add is that for many farmers, the application of 180 is just something that's happening seamlessly that they're not even thinking about. You're deducting your fertilizer from year to year that you buy and apply, and that's your practice, and it just continues.
That's exactly right. Because back to this tax form, I just put it up here one more time to kind of explain how it works. Section 180, technically, if you look at it, oh, it's a tax election. That sounds really complicated. But what the regs say is that the way you make the election is just by taking the deduction on the tax return. So it's one of those simple elections that by deducting it, you're actually making that election. And if you choose not to, like sometimes this is a little tip outside of the specific topic that we're talking about, but if you're in a year where your income is down and it doesn't really make cash flow sense to take this huge tax deduction now, you can still amortize the cost of your fertilizer over the period of its effectiveness, and that is still a legitimate way to do it as well. So that leads us up to sort of the build up to the point of this whole webinar is, can I allocate a value to the fertilizer or the fertility that's in the land that I purchase or inherit? And so one more build up thing, I guess, to kind of get to the bottom of that question. And that is, okay, if I'm a farmer and I purchase a farm, look at that picture. I have a friend, Guido, who always talks about, how many assets do you see in this picture? And that's what I can say. I mean, you look at that and you see, oh, I see a farm. But to the tax person, there's a lot of assets in that picture because every building, every fence, everything that you see that is standing up on that ground is an asset that has the ability to take a tax deduction. So if I buy this farm, I'm going to allocate value to every asset and drainage tile that I can't see, those things, so that those items that are depreciable, I want to be able to take a deduction for those items. Because if I buy land, guess what? No deduction, right? So I would like to be able to take a tax deduction for something if possible. And I can do that. I can assign a value to the hog barn that I buy, and I can maybe use Section 179. I can write that whole thing off in the year, or I can depreciate it over 10 years. So lots of options. But the big question for today is there a similar cost recovery option for the kind of leftover fertilizer supply that's in the ground, that's purchased with the land? In other words, can I do the same thing I do with the buildings and the fence and the drainage tile? Can I allocate a portion of my purchase price that I pay to the seller to the value of something called excess fertility on the land? So that's the question of today, and I will say it's not as straightforward as it might seem. So we do have one little tiny piece of guidance from the IRS on this question, and that is the only formal time that the IRS has spoken on this subject. So we'll talk about that in a little bit, but I do want to unpack to start with the one piece of formal guidance that we do have from the IRS. It's in the form of a 1991 technical advice memorandum. We'll talk about the weight of that, which isn't very great in a little bit, but it's better than nothing, right? So it's something that we do have. And this little piece of guidance that the IRS put out, a taxpayer advice memo is when a taxpayer asks the IRS to weigh in on a particular issue. You might have heard of a PLR, a private letter ruling, kind of the same concept where you're asking a question, the IRS answers it. The answer they gave suggests that there may be a deduction available for the value of residual fertilizer that you purchase with your farmland. But in this guidance, they actually denied the deduction to the taxpayer. They said, nope, you're not eligible for this deduction. So it's really important for us to really kind of look in detail about what this TAM said, what it didn't say. We never want to read too much into a particular piece of guidance because ultimately, if we're trying to set up substantial authority for ourselves, our facts have to align with the facts in a particular piece of guidance, a particular regulation, that type of thing. And that's not always easy to do. So what does the code say? Well, the code actually says that a taxpayer advice memo issued after October 31st, 1976 can constitute substantial authority for a position taken on a tax return. It can't be cited as precedent. So in other words, IRS doesn't have to follow it, but I can look at it and say, hey, IRS, this is substantial authority, but in order to do that, it really has to line up with my facts. And here, I think it's kind of a weak piece of guidance because the IRS denied the deduction, right? So all we're doing here is sort of looking at what the IRS said around the outside of the ultimate decision that they made where they said no deduction for you, right? So we kind of have to be careful about putting too much weight on this particular TAM. Now, is there anything else from the IRS that has ever been published on this subject? And I'd say no guidance that could even be stretched to be considered substantial authority. There was in 1995 what we call a market segment specialization program guide. It basically was a training guide for auditors that has been taken out of print for many years. In fact, you can't find it if you search for it. You can find it if you look really, really hard. But if you did a Google search for it, you're not going to find it. So I do have a copy if somebody needs it. I could send it to you. But ultimately, it is just a little paragraph in an old audit technique guide that was never substantial authority that kind of echoes some of the things that the IRS said in this taxpayer advice memo that we're going to look at. So basically, it does suggest that you can have a deduction for residual fertilizer supply. Now, I'm going to say this multiple times, this little phrase, residual fertilizer supply, and I'm going to contrast it with what the title of this presentation is residual fertility supply. And as we sort of go along, we'll probably see a little bit of where the distinction might be. So again, if you see anybody citing the market segment specialization program, it's helpful to know that the IRS said this at one time, but in no way does it give us any sort of authority that we can rely on because it was not authoritative guidance, even at the time it was written, and now it's pulled out of print and it's not available anymore. So back to the TAM. So we want to keep rolling on this, not to bog you down too much. But again, I want to go into detail just so people sort of understand what we're actually talking about. So in this set of facts that we had with this taxpayer advice memo, the taxpayer was a corporate farm and it was owned by two shareholders, right? So we had a corporation, the two shareholders were the owners of the corporation. They were also employees, very common farm corporation setup. In 1988, the shareholders purchased a farm. So I put a picture of that farm back up, and it included land, it included a dwelling, and they bought the farmland itself. They were very creative. I really admire the way they tried to set all this up because the corporation, it purchased some other things, some other parts of the business, but it also purchased what they called residual fertilizer supply. And they said the reason there was residual fertilizer supply in this farmland that the shareholders themselves purchased is because the person who would own the land for 14 years had applied a semi-truckload of fertilizer to the land each year. Not sure why they did that, but they did. They had proof of it. And so they said, that has value. And the shareholders themselves didn't want to allocate a portion of the purchase price to it. They decided we're going to have the corporation actually buy that residual fertilizer supply. So it was very creative, and it also makes this fact pattern a little more complicated than some of the ones that we're dealing with mostly. So what happened in this business setup is that the shareholders rented the land to the corporation because the corporation was the farming entity, and the corporation farmed, grew crops. The corporation sought to amortize the residual fertilizer supply that they purchased over 7 years. This is the facts of this particular a set of facts that came before the IRS. And so what did the IRS say about this? Was the corporation entitled to take a deduction over 7 years for the value of this residual fertilizer supply that was in the ground? So the IRS said at the onset, okay, yeah, capitalized farm fertilization costs, they can be amortized. So yeah, we know that. We already kind of went through that law. But the first thing they said is, well, in order to take that deduction, you really have to be the beneficial owner of the fertilizer. And here, corporation, this residual fertilizer supply, from the people putting truckloads of fertilizer on the land for those years, that is all inseparable from the land at this point. It's integrated into the land. And so the owner of any residual fertilizer supply that is available are the shareholders, not the corporation. The shareholders own the land. They're also the owners of any residual fertilizer supply. So sorry, corporation, you can't take a deduction for this because you're not the beneficial owner. So that was kind of the big strike against them. You could say, well, that was the end, but kind of fortunate for us, the IRS didn't leave us there. They did what sometimes courts do, is they went ahead and they kind of gave the rest of the answer anyway. And that's kind of sometimes, even though we might consider that in a court opinion dicta, it's also where we sometimes get some of our best understanding of how tax law works. And so I think it was really helpful what the IRS said after saying, sorry, corporation, you can't take the deduction because you don't own this residual fertilizer supply because it's inseparable from the land that's owned by your shareholders individually. And so what the IRS continued to say are the factors that I think are still relevant to us if we're trying to understand how the IRS might interpret a deduction that we take for fertility that's in the ground when we purchase it or even inherit it. And so taxpayer must establish the presence and extent of the fertilizer in the ground. So the first thing the IRS said is you have to, in order to take a deduction, establish how much fertilizer, is the word they used, is actually in the ground. So in this case, the taxpayer, they tested the soil, but they didn't provide any data to indicate the level of the fertility that was actually attributable to fertilizer that had been applied to the land by the previous owner. And the IRS said that is an important link in the chain. The data the taxpayer provided about the level of fertility for similar parcels of land, the IRS said was useless. So what they tried to do, they tested the land, they showed how much fertility they had, and then they actually tested neighboring lands where the fertility was less, and they said, and not crazy at all to suggest that this might be a good way to prove it. They said, well, see, our fertility level is higher than theirs, so that has to be from fertilizer that was applied. IRS said, no, this is a land specific question. Land is different from parcel to parcel. Somebody might just have more fertility in the soil for other reasons other than fertilizer. You've got to prove that to us. You didn't do that. And so that's the first thing. You have to show how much fertilizer is actually still in the soil. The second thing is the residual fertilizer supply must be attributable to fertilizer that was applied by the prior owner that hasn't been depleted by crop production. And this link cannot be presumed. That's what the IRS said. You have to somehow show that the fertility that you are seeking to assign a value to actually came from fertilizer that was applied, not just inherent soil fertility that's maybe been there for 100 years. That's what the IRS said. Number 3, you have to be able to prove that your residual fertilizer supply is actually being exhausted. It's declining. You can't just take a deduction because a purchased farm has higher fertility levels than somebody else, or you have high fertility levels. You have to show that it will decline. It's declining. And so that's another thing the IRS said that you have to prove. And then you have to prove the thing that this taxpayer started off as their first strike, and you have to prove that you're the beneficial owner. So even though they lost because they weren't the beneficial owner, in this case, the IRS went on to say, you also lost because you didn't prove these other 3 things either. And those things are essential to be able to prove. So let me just stop here and say, so if I can have data that proves these things, the presence and the extent of the fertilizer that's in the ground, I can prove that the fertilizer that's in there it arose because somebody fertilized the soil. Maybe they put fertilizer down, maybe they spread manure, whatever it is that they did, it's because of that. Number three, I can show that it's going to be exhausted because it's nutrients that are available for uptake by the crops I'm growing, for example. If I can show those things, can I take a deduction? And I think that's very reasonable to take a deduction if I can show that. Could I, though, instead of amortizing it, like the taxpayer here was asking to do, could I use Section 180 to take that deduction? And so again, then we have to go back to the statute and say, well, I think we don't have any guidance that gives you the authority to do this, but I think a reasonable interpretation of Section 180 says yes, because Section 180 says you pay money or incur expense for the purchase or acquisition of fertilizer, lime, or other materials. So if you can prove all this and you're purchasing the farmland, you're actually purchasing fertilizer that's in the ground. I think it fits that parameter. But again, you have to be in the business of farming. This is the 180 deduction isn't available for the cash rent landlord unless they materially participate. And the land has to be used in farming. It cannot be your first time that you're going to just take wide open land and then you're going to add livestock to it for the first time. That will not work either. So one thing that's besides cash rent landlords that I think is left out of being able to use a 180 is if I inherit land, because I'm not purchasing that. I'm not paying money, incurring expenses for that. So if I inherit land, there's a possibility if I'm a farmer, I may be able to amortize the value of that fertilizer that comes along with that land, if I can prove those things on the prior slides, but I'm not going to be able to use Section 180 to take a deduction for that. Is there anything you'd like to add to that, Krishana?
No, you covered it thoroughly, Christine.
Line, if we're just looking at the little bit of guidance that we have from IRS, the way that the IRS analyzed the position of the taxpayer before it back in that old TAM, what kind of deduction would be allowed? Well, to me, it's a pretty modest deduction because what we're actually deducting is the value of residual fertilizer supply that's purchased. So really, it seems like it should have some tie to the value of the fertilizer that was applied in the first place. It's kind of like what's still left over, right? What would I pay for that fertilizer? I'm not going to have to fertilize now as much as I would have because there's still fertilizer left in my soil. So I think there has to be a tie to that. So generally, I think it has to correspond to the reasonable value of the unexhausted fertilizer that was applied. Because again, in this TAM, and I think reasonably under 180, my ability to deduct the cost of residual fertilizer really just flows from my right to deduct the cost of fertilizer in the first place. So what we're doing is we're taking what would otherwise just be a business deduction, but I have to take it under 180 because I'm not using it all up in 1 year, or I have to amortize it. And so really it goes back to, in my business, I use fertilizer to grow crops. Essentially is the main way, the main reason I would use fertilizer, and I can take a business deduction for that. So if I'm taking a deduction for residual fertilizer, I think it ties to that authority, that authorization that Congress has said, yes, of course, a farmer can deduct the cost of fertilizer. Anything else on that one?
No, I think we can keep going.
So this is a really interesting point that I want to bring up. So what about the seller? So, right? So if I'm buying farmland, we just talked about the thing that I have to complete a purchase price allocation to see how much of the price I'm going to put to land, to buildings, to fence, to all that. That's part of the sale. If I'm selling a farm, I also have to allocate the sales price to the different assets, because if I depreciated, for example, a hog barn and now I'm selling it, I'm going to have some recapture that I'm going to have to pay ordinary income tax instead of capital gains tax. And so gain from the sale of land is generally going to be long-term capital gain treatment, maximum rate 20%, unless I'm subject to the 3.8% tax too. And so gain from the sale of assets that I have depreciated or already gotten a tax benefit for, I'm usually going to have to pay ordinary income tax rates, which are generally going to be higher than the 20% maximum rate for the capital gains tax. So in other words, if I'm selling something, my incentive is to have everything be land. And if I'm buying something, my incentive is to have everything be something I can take a tax deduction for, because I really like to have that cash flow. Well, do they have to match? And so the answer is, if I'm not disposing of a trade or business, no, but that doesn't mean that it's not important to have them reasonable on both sides, and it's kind of best practice to have communication. Why? Because the IRS, when they're auditing, they can go talk to that seller, they can go talk to that buyer, and they can see how the different sides treated it. So the law says if I'm disposing of a whole trade or business, then I am required to have the values line up. In that case, we have to file a Form 8594. It lists the allocations of the purchase price for each asset. They have to line up. But typically, if I sell a farm, I'm not selling the trade or business, I'm just selling the assets. And so in this case, we're not legally required to have the allocation match. No Form 8594 is required. But on audit, the IRS might examine the returns of both parties to make sure that both sides were reasonably assigning value to the proper types of assets. So the case of residual fertilizer supply leads to a really interesting question, right? If I'm selling farmland that has a value that the buyer is assigning to the fertilizer that's still in the ground, technically, as a seller, if I'm knowingly selling that asset, I'm going to have to pay ordinary income tax on the portion of that sales price that's allocable to that residual fertilizer supply. That's just the way the tax law works, because I'm kind of selling an input. It's kind of like I'm selling fertilizer to that farmer who's purchasing it and is going to deduct it when they do their tax return for that year. So best practice, if you were just looking at, well, what would be the best way to make sure everything is on the up and up? Well, the best practice would be to work with the seller and say, you know, how much did you fertilize? What was the value of that? How much do you think is left? And we do some soil testing, and we both agree to a value, and whoa, we're like in utopia. That never happens like that. But I mean, that would be best practice, right? Because then if the IRS audits you, then you can say, yeah, see, we talked about this. So what is the IRS response going to be if they audit me? And let's say I'm like John, the first example I had, I think his name was John. In my example, $5,000 an acre deduction for $10,000 an acre purchase price. And they look at that giant deduction and they say, well, what is this? Well, let's go look at the seller. And the seller's like, huh? I don't even know what you're talking about. I just sold my farmland. Well, it's going to be a red flag. And why is that? Because there's no parity, right? Like there's no parity there, because we had land that was sold that all capital gains tax was paid, and then land that was purchased, and now I have an ordinary tax deduction that wasn't accounted for on the other side. So basically the transaction doesn't balance. So is it required to balance in the law? Well, not if I'm not selling a trade or business. However, it might be evidence that your deduction is not supported in the law. Just a thought on that. But let's move on, because I've now just spent all the time talking about the residual fertilizer supply. And so in my analysis of the taxpayer advice memo, I look at the fact that I really think the deduction that's available there is really limited to anything that is, it has to kind of reasonably match the value of unexhausted fertilizer that remains in the ground. And it can't be a value that's just valuing every macro and micronutrient in the soil and then taking a deduction for that, because those nutrients might have been there forever. They're not there necessarily because somebody fertilized. They haven't been exhausted. They're not being exhausted, or they're being exhausted over decades or those types of 100 years, not over a 3-year period or something like that. And so the question is, if I want something higher than like a modest deduction for the value of unexhausted fertilizer, is there a better way? Is there another way that I can look at this farmland and I can allocate a value to all the nutrients in the soil, and I can take a deduction for that? Do I have any authority or support? And there's really 2 tax code provisions that people have looked at. And so we're going to look at those to see, do I have any support to do that? Like, and the first one is depreciation. Can I depreciate my soil nutrients? That would be cool, because that could lead to a much larger deduction than if I just have to line up my deduction to past fertilization of my soil. Well, let's look at the code provision for depreciation. Section 167, it says there shall be allowed as a deduction a reasonable allowance for the exhaustion, wear and tear of property used in a trade or business. Okay, well, maybe can I apply this to soil nutrients that exist in the land that I purchase? Can I test for all nutrients and depreciate them over their useful life? I'd first of all say, well, maybe if you would, first of all, the one thing you would still have to do, even if you're using section 167, is show that they're actually being exhausted over the useful life that you're depreciating them. So that might be a difficult thing if you're sort of valuing all of these nutrients. But let's start at the top. And the first well-known tax rule is that farmers cannot depreciate land. We all know that. Like, why? Because the case law has always said farmland doesn't wear out. So we have regulation 167A6. It says farmers can claim a reasonable allowance for depreciation on farm buildings, farm machinery, other physical property, but this does not include land. It's just, we all know we cannot depreciate land. The tax court has actually said, in response to this, owners of farmland are specifically denied a deduction for exhaustion and wear and tear due to erosion, wind, and the privation of soil nutrients. Okay, so this was what you'd consider dicta. So it wasn't something the tax court said that was required to decide the case before it. So we can't just pull this out and say, this is the law. But it is a very good indication of how a court might look at it. It specifically looked at the exhaustion of soil nutrients as really being part of the farmland, and you can't deduct the cost of farmland. And also one thing that I have to kind of point out here, I call it a nagging comment, because really that comment that they made in that TAM we looked at, remember it said, oh, that it wouldn't even let the corporation take the deduction because it said that the fertilizer supply was so incorporated into the land that for all practical purposes, it was inseparable. Well, if something is so inseparable from the land, then it would seem to support what the court case said here, that yeah, if you can't depreciate land, you can't depreciate the soil nutrients within the land either. Now we have a little more authority even than just this one court case that I quoted from. There actually was a Court of Appeals case from the Fifth Circuit back in 1977 that is on point to some extent. And this was where a farmer tried to depreciate the value of his peat soil. Now, we don't have time to go into all the details of what is peat soil, but the case was Duda and Sons, and the topsoil of the farmer's land consisted of peat and muck soil composed of partially decomposed plant deposits. This is in the South. And the soil was uniquely rich. It had greater value than other soils. But the only way that this farmer could grow vegetables was to drain his land, compact the soil, provide various chemicals. And this caused his soil to subside and oxidize at a rate of 15 inches in the first year and 1.1 inches thereafter. So he was actually losing his soil because of the way he was farming it. And he tried to depreciate it. He said, okay, if depreciation doesn't work, what about depletion? We'll look at that in a minute because my soil is vanishing. And the IRS denied the deduction. And we have to look at why. The taxpayer appealed. It went up to the Fifth Circuit. He said, hey, my peat soil, it's an exhaustible capital asset. It's separable from the underlying land. And the court said, you know what? All topsoil is subject to oxidation. It's subject to wear and tear. You made no additions or improvements on the land. You're seeking to depreciate the land itself, right? And so it said, no, you're not entitled to depreciate the deduction for the subsidence of your peat soil because that would be depreciating the value of your land. And so that sort of case stands really for the proposition, I think, that any deduction for unexhausted fertilizer supply really has to arise from the past application of fertilizer because that's an addition to the land. If you're just trying to take a deduction for all the value of the nutrients that just are by nature in your soil, then you'd be doing here what the Duda farmer was trying to do, and the court would well say, no, you're just seeking to depreciate the land itself. Another question I've thought about that's kind of a little bit out there. If you're a tax professional, you might get this. If not, don't worry. The depreciation provision actually says that you are required to take it. Like if you buy something that is depreciable, then the law says allowed or allowable, which means if I go to sell it, it doesn't matter if I didn't depreciate it physically. I didn't take a deduction. The law is going to deem that I did. In other words, I'm going to have to recapture the depreciation that I should have taken and I didn't. So it's kind of interesting to think that if we said, oh, well, you depreciate the value of your soil nutrients, well, applying the allowed or allowable concept to that, would everybody need to test their soil nutrients to see what depreciation is allowable? I mean, it's just kind of leads to a little bit of absurdity. Somebody might say, well, that's like a cost segregation, but the difference with cost segregation is I buy something and it's depreciable either as one big lot, like 39-year property where I'm actually depreciating it. The cost segregation just allows me to speed up the depreciation for some of the assets within the larger lot. Here, I'm taking something that's not depreciable and trying to create an asset that is. And that's where I think it's different. And I do not really, in my opinion, this is just my opinion, we don't have authority that states this anywhere. My opinion, it's not a good candidate for depreciation because I'm not finding things in the tax code that support it. So depreciation is one area, 167. Another tax code provision that someone might want to look at or say, hey, but what about depletion? So maybe depreciation doesn't work for the value of all of the nutrients in the soil, but what about depletion? Now, depletion is under provision section 611, and that code provision says, in the case of mines, oil and gas wells, other natural deposits, and timber, there shall be allowed as a deduction in computing taxable income a reasonable allowance for depletion and for depreciation of improvements. And so the question is, well, do soil nutrients qualify as natural deposits eligible for depletion? And so I read that and I think, well, that sounds pretty good. I mean, that sounds pretty good. Let's kind of dig into that a little bit. And really the way that the tax courts have interpreted the depletion statute, I think leads us to realize that I don't think it's a good candidate for depletion either. And so let's dig into what, in particular, the Duda case in the Fifth Circuit. He said, no, you're not entitled to a depletion deduction for your wasting of the peat soil. And why is that? Well, first of all, the court explained that our depletion deduction is completely dependent on the statute. It's completely dependent on section 611. So you have to stay within the bounds of the statute. It has no independent significance in tax law as a legal or equitable principle. In other words, you can't point to anything else and say, yeah, I'm entitled to take a deduction for the oil and gas wells in the mines and the natural deposits in the timber. So in other words, I have to fit within the bounds of the statute. And looking at the statute here, the tax court said, this is not the kind of thing that falls within the parameters of depletion deductions as interpreted by the courts, as interpreted as intended by Congress. Because what the court cases have said over the years is that depletion does not apply to the situation where a natural asset wastes in place. It said it appears that depletion deductions appear limited to cases where the asset is extracted, it's severed from the land. Like in order to actually get a depletion deduction, you have to be able to take the asset away. Now, the court then said if the farmer were allowed a deduction for the peat soil, another farmer could be allowed a depletion deduction for the exhaustion of the nutrients in the soil. Like I'm a cotton farmer, then I'd be allowed to take a deduction for the nutrients in my soil. And the court said, but that would be a whole nother set of difficulties. How would we ever administer that? We can't extend that. Maybe Congress intends to grant deductions in these cases, but they sure haven't specifically made that clear. And if so, they really need to put a provision in place that addresses it in the case of a natural asset wasting in place. And a little more explanation on that idea of not being able to take a depletion deduction for a natural asset that is wasting in place. The reason is because if you have a natural asset that's wasting in place, you can replenish it. And so in the case of soil nutrients, another court has said, this is something where if in normal farming activities we take nutrients out of the soil, we can replace them with fertilizer. For that reason, we do not need a depletion deduction because you're not taking something away that can never be replaced. Now, there's one court case that did allow a depletion deduction for groundwater or water that wasted in place. And so some people have said, oh, but that then supports that a natural asset wasting in place. That was a very specific fact pattern where the court said the only reason we're allowing depletion here is because this particular land area where we're at, that water will never be restored. It will never be restored. So it's gone forever. But if you have a situation where the asset can be restored, and with soil nutrients, that's the whole point of the fertilizer, for which we do have a deduction, then you do not get depletion because that's not what the statute is intended for. So again, here's another case, the final case on this. It was the Myers case in 1976, and it held that topsoil sold by a taxpayer was a natural deposit subject to the depletion allowance. So it actually said, okay, you can deplete the removal of topsoil. Why? Because they were physically removing it. It was going away, never to be replaced. And so they said the reason this is supported is because of the ultimate exhaustibility of this resource for which depletion is claimed. So his whole topsoil was going to be gone here in 16 cuttings, and there was an actual loss of the soil. And so the court actually went ahead and explained to the IRS essentially, it's an unnecessary overgeneralization to treat the cultivation and sale of sod as we would a purely farming activity. So here, this court that allowed a depletion deduction for the removal of topsoil set it apart from just getting a depletion deduction for the diminution in value because of the exhaustion of soil nutrients. The court said a difference between the physical removal of topsoil with sod and the diminution in land value resulting from the exhaustion of soil nutrients it's different. And why? Because the latter can be replenished with fertilizer and the former cannot. So again, just to kind of summarize the law on depletion, depletion deductions are allowed only if they're supported by the statute. The statute allows you a depletion deduction if you can show that a natural deposit is extracted, never to be replenished. And the courts have said in their dicta of these cases, they've looked at that if you can replenish land with fertilizer to get those soil nutrients back in there, it is not a candidate for depletion. So that's kind of a buzz through the only court cases that really we sort of have. So depletion doesn't appear to apply to soil nutrients that are exhausted over time. Crop production is a purely farming activity for which no depletion deduction has been authorized. So there you go. So again, where does this leave us, right? So your head might be spinning because I realize we've kind of gone through a lot of law, but I kind of wanted to lay the groundwork and then now we'll kind of summarize a few things for you. So I think, and Christiana could jump in here if she wants to add anything or disagrees with me, but I think a deduction is likely allowed for the value of unexhausted fertilizer in the ground if you can establish the presence and extent of the fertilizer, if you can show that the fertilizer supply that's in the ground is attributable to fertilizer that has been applied in the past by the prior owners that hasn't yet been depleted by crop production, and then you can show that that residual fertilizer supply is actually declining. It's being pulled out of the ground for use in your growing of crops. Section 180, I think it's reasonable to use that if you're a farmer or a crop share landlord or a materially participating cash rent landlord. That's very rare to have a materially participating cash rent landlord, but if you have that situation, you can use Section 180. If you're inheriting land, you cannot use Section 180. And then, in my opinion, though, and again, this is just my opinion based on the authority that's out there, I do not think that there is substantial authority for taking a depreciation or a depletion deduction for soil nutrients. So again, just my opinion on that. Anything to add to sort of that summary of what we talked about, Christiana?
Yeah, and I agree. I mean, the first section, the deduction that's allowed for the value of unexhausted fertilizer, I mean, that ties back to the original deduction that's allowed for fertilizer when you purchase it just in your farming operation. It's logical, and 180 flows from that as well. When we start getting into those other two potential options for taking the deduction, there's just there's just not the authority out there, and there's so much that's going against it when we think about the requirement that if we're going to take a depletion deduction, that it's, the severable, that it's not something that's just wasting in place. When we think about the depreciation option, the concern is, is there really another asset that we basically can create here? And there's just not the authority that allows us to do that, which puts us in this situation where how do you take this deduction without the authority? And if you do end up doing it, it's really you need to understand the risk of what you're doing.
Exactly. So again, good people can disagree on things, and I love to talk about this. If anybody wants to chat with me, feel free to reach out to us. So we're not suggesting that anybody is doing anything untoward and taking deductions that I might say I disagree with. All my point is to try to lay out the law and then let people use their best judgment about what they think. You've got to use due diligence when you fill out a tax return, and again, different people can disagree on different things, but again, a lot of it has to do with what risk are you willing to take. So there's a couple of
I have the one more thing, and just remembering with all that, everything that we've just said, that everybody's situation is different too. When you look at the facts of whatever your situation is, there's no situation that's going to be identical. And so just remember that, and the analysis that has to be gone through for each situation.
So I'm going to just ask a couple of questions that kind of summarize, I think, some of the things that we've talked about, just to sort of make sure that everybody understands at least what position we're coming from or what we're trying to say here. So can the value of my deduction, if I purchase farm and I take a residual fertilizer deduction, can that exceed the value of past fertilizer that was applied to the land? And again, this is sort of what we said. I think there's a lot of risk if it does. Taking large deductions unrelated to the value of past fertilizer applications, I think really means that you're kind of trying to go off into taking a deduction maybe under 167 or 611, because otherwise, really the only tax code that you have to point to deduct fertility in the first place is the ability to deduct the value of fertilizer. And it seems like that deduction is only available if the nutrients are from fertilizer that is being exhausted over a predictable number of years. Anything you want to add to that one, Krishtana, just in terms of how the value of your deduction might relate to the reasonableness of it?
No, I mean, I think it's again, it's just looking at it's working with someone who can help you analyze this and really looking at um, what you have that can support a deduction and the dollar value, but then also considering if you were to end up in a situation where the deduction when it's not allowed, and you did end up having penalties, just assessing that as well, because that's going to be dependent on the amount of the deduction you took. So, the higher the deduction, the potential higher risk.
All right, another question that I've heard a lot is, can I take a deduction for non-fertilized pasture ground? And so the big thing I want to say here is, again, some of the things that I've heard are people wanting to take really large deductions for land that's not producing crops, and I just get a lot of concern about that. So you see the cattle, and any farmer out there is going to say, but that land is being fertilized because those cows are running around leaving the fertilizer naturally on that land. So if there had been livestock roaming on that land, then the idea is maybe it was fertilized naturally by those cattle, and there's probably some truth to that. But my concern with this is, how are you going to make the proof necessary to take a deduction in that case? So remember, the IRS is going to require proof that the residual fertility arose from past applications of fertilizer. And so a couple things that are important are, can you prove that the quantity and the value of the manure that was deposited by the prior owner's livestock? How would you go about doing that? Like, how much of that land was, and maybe if you have a specialist who can tell you that and you can quantify that really well and say, yeah, this is how much fertility is in this land that was really created by that fertilizer that was left by the livestock that pastured on this land by the prior owner. If you can quantify that, then maybe there's a value there. But the thing that really concerns me, and again, if you've got scientific proof that you can prove, power to you. But I just don't probably understand the science enough to make a exact statement on this. But my concern about when I say unfertilized pasture, I'd say no. Like, if you buy land that's never had livestock running, there's no fertilizer. If there's no fertilizer in the past, I don't think you can take it. But where I'm moving on now with this discussion is, okay, it was fertilized because it was fertilized by the livestock that was on that pasture. But the question is, remember, it's really important that the only reason you get a deduction is because that fertilizer is actually being used in your current business. That's why you get a deduction. And so, is the use of that pasture, is that fertility that was laid down by those prior cows, is that being exhausted by the grass that's growing? Is it the same as crops that suck that nutrient out by virtue of growing? I don't know. If you can prove that, maybe there's a deduction, but I'm guessing that deduction is pretty modest. So again, I can't say a lot about this. I'm not going to give you anything black and white because I'm not a scientist, but remember the proof that you have to make. If you're looking at a pasture, I think it's a lot more difficult than crop ground. Christiana, any thoughts on that?
No, I think you said it right. There's no black and white answer here. So it's fact specific. If the proofs can be made, maybe we're okay with it.
Can I take a deduction for land that was purchased years ago? So what about now? I hear about this. I didn't know about it. I purchased my land 10 years ago. Is there something I can do to go get the value of that deduction now? And this is a kind of a little bit of a dicey one, because my position on this is, if you can't use depreciation, 167, then I don't really see how this is possible. Because first of all, your window has closed for the business deduction, and you are going to have to prove something that's now 8 years later. How are you going to go back and make that proof? And so to me, this is really stepping out of the bounds of safety in terms of I don't know what code provision you're pointing to give you the authority. Again, if it was 167 and it had just been a matter of missing depreciation, there's sort of ways you can do that. But this is a kind of different situation, and it's also going to be difficult to go back and make that proof that you should have had at the time, if you were going to try to make this deduction. Any other thoughts on that, Krishnana? These are hard questions.
They are. I mean, I think a lot of people would like to have a yes or no answer, and unfortunately they're just not there.
So again, we kind of walked through all the slides, and we're going to see if there's questions out there in just a second here. But I kind of in summary, I just want to say, this is an area that is ripe for some kind of guidance. We would love to have the IRS weigh in on this. We would love to have a great court case. We would love to have maybe some regulations, something that tells us, maybe Congress comes in and says, yeah, you can do this. But without that, I think we're all kind of left in this place of uncertainty. And I think given the way that the tax code says that we bear the burden to prove the legitimacy of any deduction we take, it puts us at a lot of risk to step too far outside of what is supportable, through a reasonable read of the authorities that do exist. So, I just say be careful, make sure that you consult with knowledgeable tax professionals who understand the tax law very well, so that you're comfortable with the risk that you take. I'd say until authoritative guidance is issued, you really you kind of just need to figure out what risk level you're comfortable with, and just be careful, don't to go outside the bounds of what's reasonable. If again the IRS disagrees with you on audit, you could not only be liable to repay whatever deduction you took plus interest, but you could also be saddled with 20% penalty. Not for fraud. Fraud is a whole different set. We're not talking about fraud in any of this. That would be a higher percentage. We're just talking about taking a position on a tax return that's not supported by substantial authority yields a 20% penalty in addition to all the other things that you have to pay back. So just be careful out there. And again, we like to hear from people. So reach out to us if you want to discuss this any more offline as well. But as I dig in and see if there are any questions out here, Krishtana, is there anything else you want to say?
No, I think, I mean, it would be great if we got some guidance. That would be so helpful for us, all the practitioners across the country, to be able to have that framework. I mean, we do have indications from, that we've gone through on how something like this would be looked at. It's so fact dependent. I mean, I keep saying that, but the reason I do is because it truly is. And it's a discussion. Everybody who is looking at this needs to have the discussion and really look at what they have to show why they're taking the deduction. And until we have something more clear, I mean, we're just going to have to proceed in that way.
And so we do have some good questions out here. Not a lot of them, but we have a few. So just dig right in. The first one is a great one. Do these provisions have applicability with respect to 1031 exchanges? So yeah, this is a cool question that I've kind of wrestled with and looked at. Again, there's no authoritative guidance on this, but I will say when I've looked at it, 1031 exchange, in order to do that, obviously now, in the light of the Tax Cuts and Jobs Act and the new big beautiful bill did not undo the idea that our 1031 exchanges are restricted to real property. And so the question is, could I um, if I'm trading, for example, a hog barn for a farm field and I have this residual fertilizer supply, could that be 1245 property that would offset the depreciation recapture I'd otherwise have to do for the hog barn if I don't have other 1245 assets on the other side? And my position on this is no. The big reason is because it's kind of unknown whether it's 1245 property. That's a dicey question. I've looked into it. I don't think there's a clear answer. But what I do think there's a clear answer for, even though it's integrated into the land by virtue of taking a deduction for it, I think the fertilizer is not real property. The fertilizer, I think, is personal property. So I do not think it's real property, even if we were to be able to call it 1245 property. So I do not think it works in a like kind exchange. So you could differ with me on that, but there's nothing that gives me authority to classify it as real property because the only deduction I have is as fertilizer, which would be personal property. So interesting question. If you want to follow up on that, happy to do it. If you rented land before you purchased it and have been expensing fertilizer costs every year, can you now do 180 if you purchase it? And the person here is saying you can't do that, can you? And my position on this is no. And the reason is we have like tax benefit rule out there, which is just sort of a general tax rule that says, you know what, you can't take a double deduction. Take it back. The only time you can take a double deduction is if somebody dies and they have written off the cost of something and then they die and then the basis steps up and then you can take another deduction. But that doesn't apply even if you're if you're the tenant and the person that you buy the land from dies. That's not what we're talking about because you were the one that took the 180 deduction. So my position on this is if you already took a tax benefit for deducting the value of that fertilizer that's in the ground because you were the tenant and now you're buying it, you do not get a double deduction. So my position on that is no. Could the same reasoning be applied to seeds and plants? Sorry, I think that was probably related to something I was saying, and I am sorry, I don't know the context of that. You can follow up. So when looking at the verbiage used in the second point, does the fertilizer need to be applied by the prior owner? Can it be prior owner or a rentee of the land, or is it not specifically clarified? Yeah, there's no clarification. It just means, I think the way I interpret it, and that's a really good question, is just that it has to arrive. I think that what the IRS was saying is that fertility that's in the ground, that residual fertilizer has to be there because somebody fertilized the land, right? And so we just talked about the tax benefit rule. If you're the one that fertilized it, I don't think you could get to take a deduction. But if a tenant did and a different tenant did, and now you're buying that land, it doesn't matter who fertilized it. It just has to be fertilizer that was applied by somebody. What steps? Oh, this is a whole different question. Christiana, this is actually a good one. The person who asked what steps need to occur to be identified as a first-time farmer or orchard or vineyard, why don't you reach out to Christiana by email because she's the director of our Beginning Farmer Center and that's something she can help you with.
Absolutely.
Here's a question. Can a farmer take a Section 180 deduction for excess fertility on a Form 3115 and the land was purchased outside of the amendment period? And that, I think we covered that in the, you put this question in right before we talked about that very dicey question. My position is no, because I do not see authority to take a depreciation deduction for residual fertility, but somebody might disagree. And that would be the only way to be able to take that deduction is to use a Form 3115. So heirs inheriting farmland are not eligible even if they are currently farming and are Schedule F filers. So my position on this is they are not eligible to take a Section 180 present deduction for the whole value, but if they can otherwise make the proofs and all of that, they might be eligible to amortize, right? Amortization does not require you to check the same to purchase. You have to purchase it to use Section 180, by giving value. Heirs don't give value, they just get it as a gift. But if you are otherwise entitled to the deduction because you're using the land in your business, then you can amortize. Can a farmer buying the farmland that they previously rented? Okay, there's that question again. That is a big one. They previously rented the farm, applied fertilizer, deducted the cost. Again, I think that is prevented by the tax benefit rule. The code doesn't, or the law in general doesn't like you to take two deductions for the same thing unless somebody dies. And if you were the one that paid for it and you're not the one who died because you're trying to take the deduction again. If somebody else dies, basis steps up. That's a whole different thing. But I think that's all the questions. That wasn't too bad. So anything else, Christiana, that you wanted to say?
I would just say these are some great questions that you guys posed here. I mean, and I think they just highlight the uncertainty that we're living in right now in regard to this. So thanks for being here and posing your questions.
Yeah, thanks so much for taking the time to hang with us on this and listen to all the stuff that we shared. Again, I don't proclaim to have all the answers. I just try to share what I've learned and studied, and then you take that and you consider it and you apply that yourselves. So good luck out there, everybody. Reach out if you want to talk about this in any more detail. I do appreciate that. Janet's going to share with you the PowerPoint. I will include on that a link to an article that we wrote that kind of gives a little more detail as well. So again, great to see you. Good luck.
Great. Thank you guys for being with us today. I just want to note that we're able to do these presentations monthly through a series of cooperative agreements that we have set up, and we're able to have tax experts with us. And as those of you who are working through this understand, and maybe some of you don't understand, that ag taxes are not the same as business taxes. And in a lot of our rural areas, we don't have people with this particular expertise. So it is very valuable that we're able to have these experts on every month and we're able to do these webinars. These webinars are posted on farmers.gov/taxes. So we have over 2 years of these on our webpage. So if you go there, you can find on the main page, you find the previous 3. And then if you click the link on there, it will take you to all the ones we've done over the past 2 years. So there's a lot of great information there. And, you know, these are not, this is not tax advice or legal advice. This is education. These are connecting you to resources that will help you figure out your business needs and be able to connect you to ag tax experts in your area. And so with that said, I gave a few minutes to make sure. Seems like one more question came in, Christine, while I was making my spiel. So if you want to grab that one and then we can close out.
I think it just says thank you, which is very kind.
Oh, okay.
I
Good
think
deal.
so. Yeah.
Okay.
Awesome.
Okay, good. I
Thanks
just
to
saw
all
the
of you
number
who are on
change.
here. Yeah. All right. We'll see ya. Thank you.
Okay, you guys have a great afternoon and we will see you later.